All right. Good morning, everybody. It's Monday. So, if you're new around here and you haven't heard me say it before, these morning briefings, sure, I'm giving you a leg up. But when I started these, it was to teach people how to do a morning routine, how to put something together for yourself, because inevitably, you'll never find somebody else who's going to give you exactly what works for you, right? And I've always been in that spot where I want to teach people how to do something rather than just do it for them. And when I tried to develop videos on how to do this, they always ended up being 4-hour videos or a series of videos. It was just, there's too many steps to make some little how to. And I thought, well, we need a routine. We need a consistent approach to trading the markets that fits us. Each person got to have their own way. And the only way that I was able to come up with something is just to do it every day, the same thing over and over and over. And I've kind of tweaked these morning briefings a little bit over the years, but my routine doesn't change in the big picture, right? The steps that I take, but it's all designed to teach you how to do it for yourself so that you don't need me or anybody else besides maybe just some sort of, gut check. Just like I go to other places and read what other people read, watch videos, and check some of the great names out there like David Keller to get a little bit of a gut check to kind of keep me in line. So as we go through these steps, keep in mind, sure, I might be giving you a fish today, but my goal is to teach you how to fish. So the steps that we're taking might not suit you perfectly. Maybe you want to trade equities. Maybe you want to trade penny stocks. You're still going to want to do a lot of these steps. And then at some point, what I do is going to diverge from what you're going to need to do so that by the time you're done, your morning look around has got you prepared for the trading day in a way that fits what you're trying to accomplish. I use free tools as much as possible. Not that I don't have a bunch of paid resources. I've got thousands of dollars of resources, but most new traders don't need that. And even if you could afford it, you probably won't get much out of it because you wouldn't know how to use it yet. So I don't try to promote places that you got to go spend a bunch of money on to use. It starts with an idea of what's going on around the world. Let's get that global perspective. And on Mondays, this is even more important because we're not pricing in just one overnight news. We're pricing in days worth of news. And it doesn't matter that the futures market has been open all night long. As we get into the RTH at 9:30, the market's going to start pricing in things that it has not yet begun to price in. So Mondays are even more critical and dangerous when it comes to that point of view. So take a look around real-time 24-hour indexes. And I use this investing.com. I'm not signed in. It's free. You don't need an account here. Just get a look at what's going on around the world. How did we do? How's the markets doing? Which markets performed better in the overnight? Now, it helps if you've got an idea of when these markets open and when they close, and or are they closed yet at all? There's a website, tradinghours.com. It's free. It'll tell you which markets are open, what their market hours of operation are, when they close for lunch, if they're closed for holiday, and what that holiday is. So that's a really great resource you can go to get an idea of who's open and who's closed and what the cycle is. So for an example, Hong Kong is closed. They're done for the day, but they've got futures just like we do. So they're still moving, just like our S&P is moving, our NASDAQ is moving. They did really good in the overnight, up 1.5%. Now, Japan basically flat this morning, but they are green. Our markets are down the most, but the Dow is barely down at all. And a lot of that has to do with Boeing. Boeing is in the Dow. Boeing's got really good news, and Boeing is up. So it's holding up the Dow better than a lot of these other indexes are doing. But when we take a look at what's going on, a lot of these, while I'm not going to say that, that they don't matter at all, they fall down the scale of importance. So kind of keep your eye on Hong Kong, Europe, Japan, and then our markets. The others, sure, they matter, but they're not going to give us the impact on a day-to-day basis that would make it too much of a concern. So how are we doing around the world? Mostly flat, sure, a little bit out of Hong Kong and a little bit out of the UK, but otherwise we're not overly negative and we're not overly positive. My benchmark is 0.5%. So if it's not up or down at least 0.5%, then really just consider it flat. And when we use that benchmark, the only thing that's up more than 0.5% is the UK 100 and Hong Kong. Not much out there yet. Different economic websites are going to give you a different point of view. MarketWatch only deals with the biggest things. So if they don't consider it a big economic event, they won't bother listing it at all. This is good when you're just wanting that highest level of, hey, what's the biggest thing out here today? Or is there any big thing at all? We've got Fed Governor Lisa Cook and then the monthly U.S. federal budget at 2 o'clock. That's the only thing that they really deem relevant today. So, a very stripped down focus. Take a look at something like FX Street. They try to put everything in here, and not just for our nation. So we've got Europe, Australia, the British pound, Bank of England. They're throwing everything that they can find in here. But even this isn't everything. There's a lot of economic data points that never get to the surface. Boring little quiet stuff like the amount of grain leaving the New York harbor. That's an economic data point. Just for an example, probably one that you've never even heard of. And there's a lot more of those. So every half hour, an hour, 24 hours a day, there's economic data coming out. We can't catch them all. And really, you don't want to try to. You can just watch the clock. Every half hour, there's another data point. Every new hour, there's a data point, even if you don't know what that data point is. Now, at FX Street, they like to use these impact bars. The darker the bar, the more likely the impact is to the market. Will there be violence? Will there be volatility? Is there likely to be a big move? If it's got a dark bar, there's likely to be a big move. If it's a really light bar, then historically it hasn't been known to cause big moves. And that doesn't mean that it can't, just that we're not expecting it to. Get something like Finance Juice. It's a little bit like FX Street and a little bit like the MarketWatch. Some of the bigger stuff and then some of the more minor stuff. This is my go-to for changing conditions. So I tend to watch this throughout the day, but it's also a good place to start in the morning. And it's the same thing, same idea. Fed speakers of various kinds from around the world. This is usually my go-to for who's speaking today. They tend to be more willing to change what's on the side here to add, say, the president is going to speak at 2 o'clock, right? If we didn't know and suddenly we do, they'll take the opportunity to add that. So kind of my go-to on this one. This does have a filter, by the way, and you can make a free account. I recommend doing that. Make a free account so that you can use the filter and it will remember your settings. Just click on My News, open it up and get rid of stuff like Fox News, CNBC. You don't want that stuff, right? That's not the kind of news you want. So we could see for today, we mainly got some Fed speakers. We've got a little bit of expectation, inflation expectations. And at 2 o'clock, we've got the U.S. federal budget. So there is data today that is relevant and likely is impactful, but this is the calm before the storm. This is before CPI, which is coming in this week. It's very likely that the CPI print that we get this week is going to be more impactful than the FOMC that we got a few weeks back. And really think about that for a minute. The impact expectation for CPI this week is likely to be greater than what we saw for FOMC 2 weeks ago. So know what you own, right? Really give some consideration into what you're holding on to in your swings. Here's the spot gamma levels if you want to catch a screenshot. Trading Views a Black Friday event starts next week, I believe. So if you don't have the premium, I think they're doing 70% off this year, which is just fantastic. This is a threat that we need to continue to keep our eye on is US dollar Japan. It's getting up into the same level as last year when we had intervention. Now, by itself, just US dollar Japan being up at that level isn't enough. We need to keep our eye on the Japan 10-year. You can see how we're pulled back a bit. Looks kind of a little bit like a head and shoulders, but that's not really the pressing thing. When we put it on a weekly, the bullishness really stands out. It's really easy to spot the threat that this carries for us. They're not going to announce in advance, hey, we're going to intervene now. And after they do intervene, just like last time, they'll deny it for a while, right? Until they have to open the books, because just like with our treasuries, the money's kept track of, so they can't intervene and hide it forever. When they intervened last year and was first asked about it, they said, oh, no, we didn't do anything. But then, of course, it came out eventually. Intervention here is likely to cause the Dixie, the DXY, to fall, and the US 10-year to fall, and that will cause the S&P, the NASDAQ, the rest of the markets to rise up. Last time we had intervention in the intraday, the S&P moved 1.5% in an hour. 1 hour. And it moved over 6% over the next week or so. So right now, the Dixie, the DXY, the dollar index, we are pulled back a bit, but this is still bullish, right? This is still a topping pattern. And until we get through this low here, this 104, call it 105, just for some easy discussion. Until we break that 105 and set a new lower low with preferably our second lower high by that time, then we could say that we've got the Dixie in a move to the downside. But until then, this is still bullish, and it's still holding above even the bare minimum, a halfback level. Additional auctions right up in the front end. You could use something like IRX, but we got 3-month and 6-month auctions at 11:30. So this kind of ties in with the idea that today's lunch may not be a pause event like it normally is, that we could move right through lunch. We're still above 0 gamma, bullish above, bearish below. The put wall is a long ways off, 4,200. And the call wall is around 45.50, I believe. 44.65 right there. Kind of gets buried underneath all these other bubbles. Volume came in at 90 this morning. That's about normal. It's not overly heavy, not overly light. We have an MDP, that's a missed daily pivot. So we can see the daily pivot point down here. We haven't hit it. That has weight for us tomorrow, not really today, but it's still important to recognize that we have not yet hit that pivot point. There's a trade strategy that goes with that. I don't necessarily use the strategy, but I love the insight that comes with a missed daily pivot. The fact that we have one here, especially after going sideways through here, kind of holds some weight to it. If you want to know more about missed daily pivots and the strategy that goes with it, it's not mine to teach. You can search for it on Google. You'll find it pretty easy. Just missed daily pivot. It's what MDP. This big bar here is about a 6% move. So we were talking about US dollar Japan and that intervention and how the market could move a good 6% over the next week or so. If we were to see some sort of intervention, that's a 6% bar right there, 5.99, and it's close enough, right? So, you know, if there is some intervention that hits the markets, it will be violent and fast. And it's anticipated to be an upside move. This is a weekly chart. You can see how we're through all of the major moving averages at this point. The only one I don't have on here would be a surge level, say like a 3-period moving average. But we're above the 10, the 20, the 50, the 200. Now we're kind of flirting around with this 20 period today. That'd be a 20 simple. But, you know, we cut through it last week, closed above it. We're kind of negotiating with it right here. It's sideways. We don't really give sideways moving averages much merit. What's more important are these wicks back here. So sure, we've come up through there, but when it comes to liquidity, you know, until we get through it, definitively close above it, then we don't know if we've got all of this liquidity done yet. Because, you know, pulling and stacking, we can wipe that level out. And then as we drift back, they'll just reload the level, which means the next time we were to come up here, we would still yet again have a bunch of sellers sitting up there. So we don't know if that level is done yet. Right now, we're focused on getting an inside week breakout. It's pretty simple. We want to break above last week's high. While we're working on that, we need to stay above the 50% level of last week, a half back. So 43.94, 43.93. This 43.90 area is a yearly level. It's got a lot of weight behind it in optionality and technical analysis, seasonality. It's just a really critical level. And we could pinch pennies and talk about, you know, 43.92, 43.91, 43.94, whatever. It's the lower end of the 43.90 zone, right? And when it comes to analysis, you don't want to imagine drawing with a sharp pencil, right? Imagine drawing with a fat, dull crayon. It's a big, wide zone, because this isn't about nailing it down to the tick. So we really want to see the market hold above that 43.95 area. If we start breaking below that zone, then we're going to focus on a half back break, which would get us back to 43.71, and then the low of the previous week, which would tangle us up into all of those moving averages. That's not the base case at the moment, though. Looking at it on the daily, we are above everything. There's no moving averages in our way. There's no pivot points in our way. The next upside target, round number 4450 and then 4500. Just like with the inside week breakout, we've got an inside day at the moment. We need to hold above 50% of Friday's level, which happens to be the same level. 43.9488. Got that same wick discussion back here to deal with. And right now, since we're underneath these pivots, any move to the upside will focus on Friday's close, which is also the weekly close, and then Friday's high. Got to break through those pivot points before we can have any consideration of a move to the upside. $44.11 cog line is also a voodoo line. That was kind of our support in the overnight. The ADR is 44.54. Now ADR, average daily range, you know, it sounds complex. It sounds complicated. ATR, ADR, average daily range. Just to put it into some normal English, it's what we do on a daily basis, on average, over the last 21 days. It's what we've been doing. We've went that far. So the analogy that I like to use is, you know, you go by the gas station and you see gas is $5. Every day you go by there, it's $5, $5, $5. Every day it's $5. One day you go by, it's $9. Even if you need gas, you're not stopping. No way. You know its average is $5. You're not buying it today for $9. But if you go by that same gas station 20 days in a row, every day it's $5, $5, $5. Today you go by, it's $2. Well, even if you don't need gas, you're probably going to pull in and get some gas because, wow, its average is $5. It's at $2 right now. Might as well load some up. What does the ES do on a day-to-day basis? It moves about 1.3%. It's what it has been doing over the last 21 days. That 1.3% is the distance between these two red lines. So if we're going to do today what we've been doing on average day after day after day over the last 20 days, we're going to go to one of those red lines. Now, there's times where we don't, because, you know, this is an average, not a promise. So any hint, any indication that we're moving towards one of those lines, that becomes the target. A good step in that direction, if we break our own Globex low, the likelihood that we're going to that red line increases by over 50%. We break this pivot point and the likelihood that we're going to that red line goes to 90%. We break this previous week's high, yesterday's high, going to this red line increases drastically, right? So any indication that we're going in that direction, right now we're just trapped in between this high pivot and this low pivot. We got to get out of this zone for anything else. And look, it's tradable. You want to sit in there and trade in that zone, it's totally doable. But if you're losing more often than you win and you find trading difficult, that's probably what you're going to want to avoid, because while it is doable, it's going to be difficult more often than not. So don't do the hard stuff, do the easy stuff. 10-day, 30-minute volume profile here. This is the classic P shape. If we look at it from back here, we've got the point of control up here, and on the TPO also, we've got the point of control up there. If we break this 4360, 4355 area, it's a shallow profile, and we're likely to fall through that really fast, just like we climbed through that really fast on the way up. There's not much there for sustainability. So call it an air pocket of risk, right? That's not my phrase, but it fits, and it's just it's elegant in its simplicity. It's an air pocket of risk. So if we do break that low, the next area where we see any sort of real help is around 4,200. I don't think that this would be much more than a speed bump, that 43.32 cog line. Five-day, 5-minute, call it mapping out the 5x5. And generally, we would look to carry forward the previous day's points of control. We're going to widen this out a little bit so we can catch those other points. Just take one of these lines. We haven't had a point of control to carry forward for a little bit now. We were sideways through these days, just cutting through those points of control so much that there wasn't anything to carry forward. But with all that volume that we got into the close on Friday, we were able to end up with a point of control over our head. Now, I don't have the TPO for Friday anymore, but we didn't spend a whole lot of time up here, and yet that's where the greatest amount of volume was located. So that's really telling. We hit a ceiling there, right? We ran up into that massive amount of volume. So this is going to be a little bit of a trick to get through there. It's not to say that we can't get through there. It's not a resistance level per se. That's kind of an antiquated idea, support and resistance. It's more of the idea that that's where the greatest amount of trading happened in the least amount of time. It's very likely that there's unfinished business there. Other participants who wanted to trade at that location didn't get a chance to do so, which means if we get back to that location, they're going to get their chance, and they're very likely going to take it. Whether they are buying or selling at this point doesn't even matter. It'll just be the fact that there's very likely going to be a lot of trading right at that level, and that's going to make it difficult to get through there. So first touch plays become valuable at that point. 44.31, 44.32, that's a cog line, by the way. So COG, center of gravity. And if we were to turn on the voodoo lines, I would not be surprised if it's also a voodoo line. So we're very likely going to have a difficult time getting through that level. But once we get above it, then it ought to act a little bit like the same thing in reverse, right? Once we hold above it, we should stay above it. And if we come down into it, there's very likely going to be a lot of trading again, not an antiquated model like, quote, support or resistance, but more of just unfinished business. There's likely to be a lot of trading, even if we fade back to it after we're already above it. Now, if we did want to try to see that level, one thing that we could try to do would be to turn off the extended hours trading and now look at the VPOC or the TPO profile versus the RTH profile on the volume. So the point of control is still sitting up there. It's a little lower than what I had marked, but not by much. And you can see that we didn't spend, you know, an inordinate amount of time there. And yet we do have the most volume there. In fact, it's a little shallow at that spot. So we use TPO to gauge how much time we've spent at a particular location. It's volume by time. We use volume profile as volume by price, right? So we didn't spend very much time there at all, but it's where the point of control is. So that tells us it was a massive amount of volume. Now we could use a footprint chart or what Thinkorswim calls monkey bars, and we could see exactly how much volume there was at that time frame and where that really big order came in and whether it was a single order or, you know, a reconstructed sweep or block or something like that. But at the end of the day, at this point, it doesn't really matter, right? It just matters that that's where the point of control is. We talked about the weekly pivot point last week and how it was going to be brought up. We don't see it this morning because it's buried behind our daily pivot point. So tomorrow, when the daily pivot point is no longer sitting where it is today, we'll see that weekly pivot point. That's how big of a change we have from our weekly pivot. That's a pretty good change. The good thing from that is that we're no longer way overextended beyond our weekly pivot point, right? This distance from the weekly pivot was one of my concerns from last week, that we were just so far away from that level. Not anymore. Now, on one side of this point of view, that's a good thing because we're no longer so far extended away from that level. But on the other hand, it makes it easier for us to get underneath it, to break through it and then be under it. We're 1.25% above the 10-week, and that's on the decline. We were a little higher than that. Now we're fading back a little bit. We tend to run this in waves. And we're 1.3% above the 10-day. Also on our way back down to it. It's rising up to us, and we're coming down to meet it. So it shouldn't take long before we interact with that 10. Now, Friday, we looked at the distance for this new expected move, compared it to the distance from the previous week, and it wasn't much different, right? It was just a little, came in a little light. Now we're noticing that by the end of the day yesterday, volatility had actually increased a little bit. So this week's expected move range is just a little bit bigger than last week's range. The volatility continues to widen out. And when we were talking yesterday or Friday in the morning briefing, we were still flirting with this open from the previous Friday, or from the close of the previous Friday. We managed to make it all the way to the edge of the weekly expected move on Friday. That's how far we were supposed to travel in an entire week. We made that entire distance plus some in one day. Volatility is a nerd word for movement. So we are still in a high volatility environment. We don't need to look at something like the VIX or volatility tools to tell us that we're in a high volatility environment. We can look at price action. From candle close to candle close, the distance between those two, that's volatility. If you go to a daily chart and turn on the implied volatility indicator, That's what it's measuring. They might as well just have called this candle close to candle close. That would have been a much better name for that indicator, because at least then we wouldn't confuse it with something else. So volatility is still here. It's getting bigger. That's why the range for this week is wider than last week. It's not done yet. The threat is still here, which all comes down to say, if you're doing option selling to open, that's really dangerous right now, especially with everything that we have on deck. This is a very violent, dangerous week, and you can't get far enough out of the money to sell options on a week like this. But with the expectation of a week like this, where we could make really big sweeping moves in a short duration, options are still cheap, even in this high volatility environment. And some far out of the money, zero chance in hell of winning put or call, crazy cheap, far out of the money stuff has a chance of actually turning profitable. So something to consider. You're better off on a week like this buying something far out of the money than trying to sell something far out of the money. The good thing is with the low expectation of profit, the costs are really low, right? Because it's a balanced and fair market. Bitcoin down 1%. And really that's the only thing up there that really fits. Now Bitcoin went up 6.5% over 5 days. So, I mean, that's pretty fantastic. This XXX bull leveraged semiconductor made a 12% move last week. So it kind of makes sense that it's pulled back a little bit now. But semiconductors last week were pretty hot, right? And the fact that it's off of nearly a 13% run, I mean, you can't be surprised at that point, right? Even with the S&P last week keeping its gains and going higher, the VIX also went up more than 1.25 last week over a 5-day period. And it's up this morning. Just got to be careful with the VIX because it's got those different expirations. And so it can be up from just nothing more than a contract change. Nat gas is up close to 5%. The China ADRs through KWeb is up. So that'll give us insight into, say, Baidu. Got that big gap up here. Some JD, but JD looks like it's giving it back. And PDD, but it also looks like it's trying to give a little bit back. It's still gapped up though, considering where it closed and where it's at this morning. We had an inside week breakout already on PDD. So if we look at the week from last week, it closed down here at 109. This morning, it was already broke out above last week's high. It didn't keep it, but it's a pretty good start. Looking at these wicks, though, that's going to be a hard thing to get through, right? It's going to be pretty difficult. But if we're using OCR analysis, we are on the run up. So far, that prints us a higher high. We'll see. So we got the China ADRs. And that's it. These other ones don't have the movement. Remember, the benchmark is 0.5%. So if we're not up at least that much, all right, so we got to move in bonds here. I'm going to say that this is some kind of contract change. This is an ETF. There's probably a rebalance or a readjustment. So we're going to just ignore that for the moment. We'll find some other bonds to look at. Bitcoin products down, 1.25. Semiconductors nearly 1%. Solar down more than 0.5%. Airlines down 0.5%, and just regular TLT, the 20-year bonds down 0.5%. We're starting to see precious metals, but they're not quite at the benchmark. But if we continue to see US dollar Japan rise, then it's expected that we're going to see silver, gold miners also moving to the downside. Silver's almost there. It's almost at 0.5%. Looking at what's up. Nat gas, the China ADRs, gold, interestingly enough, which shouldn't be, but it is. Uranium, there's that change. Yeah, it just needed to rebalance a little bit. Gold is not up anymore. It just needed to get caught up. So we got uranium, China ADRs, nat gas, and really that's it to the upside. We don't even have pot stocks. I really think this is the calm before the storm. So, kind of keep in mind, sure, we can move around. We're just not expecting expansion, right? And what that really kind of implies is that we sell into strength, we buy into weakness, we expect to hold the line and keep the range until we get into, our economic data points on the week. And we got big ones this week. I mean, we got big stuff coming in today, but that CPI that's coming in, that's not today, and it's very likely the biggest thing on the week. So I want to keep our eye on the Dixie, on the DXY. We had a reasonably mild week last week where we just kind of held this zone. And we want to see a continuation of that. Sure, it's running hard to the upside right now, but notice it's running hard to the upside right now and we're not falling down. If we'd have seen a move like that 3 months ago, we would see an equal and opposite reaction to the downside. We'd have seen the S&P and the NASDAQ falling straight down. And that's not what we have this morning. So that disconnect is solidly in place. We can't use things like the dollar right now, the dollar index, for a tit for tat equal weight measurement where we see it going down, we try to go long, or we see it going up and we try to go short. Don't do that right now. Obviously, it's not working. Instead, use the Dixie by levels. Is it above 105, above 105.5, above 106, above 107? As long as right now, as long as it's below 106, the expectation is that the markets probably won't sell off too bad. We get above 106, which would be a breakout above Friday's level, basically. Then we got to consider the S&P and the NASDAQ's probably going to reflect that and maybe show us some weakness. Not selling off into oblivion, just maybe retesting our own Globex low at that point. maybe expanding towards the 50% mark of the previous day. Same thing with the 10-year. If right now we're just holding inside of Thursdays and Fridays levels. So as long as we continue to do that, then this little bit of a move up really isn't reflecting in the market at all, right? We're not seeing an equal and opposite reaction here. But we start to see, say, the 10-year get above Friday's high, for an example, or our own Globex high, and begin to expand higher than that, call it above 4.7%, we're very likely going to see, an impact out of the market. So it tells us that our tools are still broken. They're not functioning correctly. We can't lean on them the way that we normally have been able to do, over the last 18 months or so. Really approach with caution, especially a day like this. And as we get into the open, there's still a lot of news the market's going to be pricing in from the weekend. It can often take 30 to 45 minutes to price in all that news, right? On a normal day, it could take that long. On Mondays, it could take even longer than that. We are starting to see a little bit of a reaction out of US dollar Japan too. And this is not supposed to be looking like this, right? We've got the Dixie going up over here. The Dixie's the first part of this pair. So if the Dixie was moving up, this should be moving up. And instead we got this little itty bitty down candle here and this really big candle here. So this is just stressing caution, right? Nice and easy. Be careful, watch the clock. Everybody have a good week. I'll see y'all tomorrow.